Dell reported quarterly financial results that sent the stock price lower. Of course, I'm disappointed in that because I had Dell stock rated as a buy, and I'm always disappointed when I have stocks rated as a buy and the performance disappoints. Of course, I'm going to update that recommendation in this video. I'm not like the other YouTubers that when they make a recommendation that doesn't work out, they ignore that company and they only talk about the ones that worked well. That's not what my channel is about. I always go back and update companies that I cover, regardless if the performance is doing well or if the performance is doing poorly, because I know you're interested in these companies and I know you still need to know about these companies to make decisions on buying or selling. And that's what's important to me, to provide information to help you make more informed investment decisions. So I'll review the company's latest quarterly results. I will share with you my updated proprietary discounted cash flow model, which calculates a fair value for the stock. I'll also look at valuation on a forward price to earnings basis, and I'll update my buy, hold, or sell rating on Dell and let you know where my rating stands following these quarterly financial results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so Dell reported record revenue of 29.8 billion, and that was up 19% year over year. Operating income came in at 1.8 billion, which is up 27% year over year. Still, if you take the operating income and divide it by revenue, you'll notice this is not a very lucrative business. It doesn't generate very high profit margins, and I've been talking about that for a few years now. These companies, including Dell, Hewlett Packard Enterprises, and Supermicro Computer, they don't generate very strong profit margins. This isn't a very lucrative segment of the artificial intelligence industry. They are definitely growing revenue. Revenue is soaring in these segments, but they're not coming with high margins. And that's been some of the downside with these companies and why they sell at relatively cheap valuations when you look at forward PE multiples for companies that are growing revenue as quickly as these companies are growing revenue. The forward price to earnings multiples are relatively low. And the reason for that is the not very attractive profit margins for the industry overall. Still, Dell's saying that they now ship $10 billion of AI solutions in the first half of their fiscal year 2026, and that already beat all its shipments for 2025. Demand for their AI solutions continues to be exceptional, and they're raising their server shipment guidance for 2026 to $20 billion. So that part of its business is absolutely thriving. But one of the downsides, as I mentioned, is the relatively small profit margins. And then another reason why Dell stock is underperforming is because it still generates a large percentage of its business on client services or personal computers and computers for businesses. And that segment is not growing very well at all. In fact, in that segment, revenue came in at 12.5 billion, which is up just 1% year over year. So that's a really slow growing part of its business. It's a mature industry, not expected to grow very quickly for, 5, 10, 15 years. It's not a growth business, and it makes up still almost half of its business. But over recent quarters, as the Infrastructure Solutions Group, which is where the AI business is housed, as that part of the business has grown much faster, it's now a larger part of its overall business. 17 billion compared to 12.5 billion for the other segments. So today, you're getting a business that's more concentrated on server solutions, which now is where the data center is optimized for artificial intelligence. That's where all the growth is coming from. And you've got a business that's more concentrated in that segment. And that's good news for investors. So for the full year in 2026, Dell is expecting $107 billion in revenue, and that would be up 12% at the midpoint. And they're expecting earnings per share to come in at roughly $8, and that would be up 25% year over year. So excellent growth in revenue and earnings per share, nearly all of which being driven by the infrastructure group, which is where all the data centers being built, optimized for AI. Nearly all of its growth is coming from that segment, very little growth from the other segment. So let me share with you my proprietary DCF valuation for Dell, which I updated this morning or this afternoon, I should say. And the intrinsic value per share I calculated for Dell came to $152 per share. Current market price is $122 per share. Now, the current market price updates automatically during normal market trading hours. And since today is Labor Day, it's a holiday, it's not updating as I'm recording this video, but during normal trading hours, this whole spreadsheet, there are several inputs in this spreadsheet that update automatically during trading hours. So that's why you'll notice the intrinsic value per share changes during trading hours. It doesn't change by all that much because of the inputs that are changing are not changing the intrinsic value per share by a large percentage, maybe a few dollars here and there. But the inputs that are automatically updating include the intrinsic value per share, the value of equity, the current market price, the number of shares outstanding, and the company's uh, weighted average cost of capital. And this is true for many of these discounted cash flow valuation models that I have for my channel members. If you have access, then keep tabs on these, check on them every few days or so, depending on how often you're trading or making investment decisions. I also like to look at valuation on a forward price to earnings basis, and fiscal.ai is my preferred destination to retrieve these forward PE multiples. And Dell is now trading at a forward PE of 11.84, which I feel like is fairly valued for a business with its margin profile and its growth expectations. 11.84, I would say, is fairly valued, closer to being undervalued than being overvalued. And then let me remind everyone the intrinsic value per share being so much higher than the current market price, even after applying a margin of safety, it still looks undervalued. So to update investors, I last covered Dell on April 1st, where I rated this stock as a buy. And after seeing these latest earnings results, I'm reiterating my buy recommendation for Dell stock investors. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.